welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, at a time when so much is happening around us, Russia and Ukraine are at war, oil prices are at an all-time high, inflation is at an all-time high in the last 4 decades, then the pandemic is going on for 2 years now. And amid all of this, the stock market is also in the midst of a correction. So it's only natural for investors to be worried about their investments. To help us make sense of what is happening around us and how to deal with this situation in terms of our investments, we are joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
What is really happening and how should the investors, cope up with this?
No, I can add many more things to it, which is, for Indian investors, the dimensions are many more. Foreign investors are pulling out. The anxiety, our biggest import bill is oil, and the price going up has a big impact on many sectors of our country. Then Russia is a big trading partner, but we have been trading in dollars, and we still don't have a bipartite ruble trade mechanism with them. So what happens to it? How do we deal with it? And we are not in an economy where we don't do barter trade with them, that okay, we will give you wheat and you give us the oil. It doesn't work like that anymore. And so in that sense, the anxiety and the uncertainty around many of these developments, Indian investors have more to worry about. Foreign investors are pulling out. When they are pulling out, the rupee is depreciating in an accelerated way. It has gone to a record low.
Yeah.
Our imports will become more expensive, and our markets are crumbling because market has been extremely resilient given the scale of the magnitude of
What is happening?
pull out. The scale of money that has been taken away, that has been taken back from the market, is of a scale when we had a similar scale of withdrawal from the market by foreign investors in 2008. And the result of that was 50%, more than 50% decline from the all-time high of the Sensex. Sensex went down from 20,000 points to 8,500. So if that is the scale of decline, we haven't seen anything. In fact, India has become far more Atmanirbhar, so to say, because we have domestic investors putting in as much money. We have the Employee Provident Fund Organization, the National Pension System. So, and that is besides the massive IPOs, which have sucked the liquidity in the market. So, I think we are far more resilient than ever time in the past on the market dimension. Now comes, is there a reason to be optimistic about the future? If you are very pessimistic about the future, you think that you'll be worse off we as a country, we as an economy, we as citizens of this country will be worse off in 5 years' time on the economic front. You should take your money out. But if you think that things will improve, and my sense is that we are still in the middle of we still have to see the fruits of the big thing that has happened in our economy. We have seen the corporate tax rate going down. For the first time, we are witnessing a sustained lower interest rate for citizens. We find that many of the sectors are being opened up. The GST, the formalization of the economy is still underway. We are still at a stage. Look at the scale of economy. At the outset, when GST was rolled out, the GST mobilization or the monthly mobilization was less than 100,000 crore a month. Now the routine is 135 crore a month. So that is a 35% rise in the formal scale of operations of the economy. That apart, we still have big chunks of our economy which is not under the GST regime. Oil is still not there. So, it's alcohol is not part of the GST regime. So our economy is much bigger, is getting formalized, and I think all these things will translate into something very significant. So I think for investors, the lesson is pretty simple. Should you do more? Should you do less? And should you do nothing? You should doing less, doing more will not help you in any way. Should you do nothing? Yes, in one case. If you don't have a plan, make a plan. Then start following that plan. If you are onto a plan, stick to that plan. Watch less TV. Make sure that the money that you are investing, that is getting rooted, that is getting invested in the market, you are unlikely to need it for a couple of years. Because if this money is likely to be, is needed in 6 months time, 1 year's time for something important, that money should not be in equity in the first place.
Considering all of it, whatever you've said, why don't you give three do's and don'ts for long-term investors, three do's and don'ts for medium-term investors, and three do's and don'ts for short-term investors?
I don't have anything for the short-term investor. In fact, the short-term investor should just listen to should take to heart one lesson, that markets are unpredictable on a short-term basis. And if you don't agree, if you don't believe this, just look at last 2 weeks. The market performance. One day it goes down by 5%. Next day it recovers by 4%. Then it's very hard to predict it on a day-to-day
Simply
basis.
put, stay away from equity, short-term
Stay
investors.
away from equity. Short-term investors, they should be invested in appropriate kind of fund.
Yeah.
Money for few days in liquid fund. Money for few months invested in an ultra short-term bond fund. Money for a year or two. You are a risk-averse investor. Invest in a short-term bond fund. That is it. Don't even try to benefit from the interest rate decline or rise, because that is also not predictable. Everybody was expecting that interest rates will go down in India because it was at an high. And it was at a high, and now it is that is ruled out. And RBI governor last quarterly meeting, everybody was expecting that there might be a 25 basis point cut, but he said that no, this is not the time to hike, and it's not the time to do that. And it turned out to be true. But I don't think they're great at predicting what will happen all over the world. But general economic resilience is definitely reflected there, and I don't think it is easy to guess. And last 5 years, all the interest rate changes were not predicted by the finest and the senior most fixed income fund managers in the country. So I don't have any hope that anybody can do it right. Medium term investors, they can do something about it. That is what the asset allocation is for. There are investors who were actually long term investor, and now they are medium term investor as they are approaching a goal. And approaching a goal in 2 years time, approaching a goal in 1 year's time, approaching a goal in within 5 years, while you are a long term investor for 10 years, it's something which is a very lot of people don't have an asset allocation in their mind. But you can have a simple plan that as you get, as you keep investing regularly, as you get closer to your goal, take your money out methodically and regularly. Don't wait for the last time, because you cannot depend on the market for an important goal. You think that you need the money in 5 years time, but you can't really, or you need the money in 2 years time, but you can't wait for the last day. Last day the weather can be bad in the market, and that could be a very devastating thing and more disappointing and a big regret. So get out of it methodically. So most medium term investors should consider that. Long term investor, I think it entirely depends. My suggestion will be for broadly two set of long term investors. One who are new, or maybe three kind of investors. One who will be investing for the first time. Start conservatively. Start with a balanced advantage fund. Start with a hybrid, aggressive hybrid fund. Do your SIP. Never invest lump sum. Never start with a lump sum. So new investors should do that. Then anybody who has limited experience should still be conservative. If you came in the market in 2-3 years and you started with a small cap fund, you are lucky that the small caps haven't fallen as much. Become conservative. Be more diverse. Have a slightly higher fixed income allocation. Have 25-30% into fixed income, so that you can profit from any market decline. You will rebalance it to 25-75, and you will benefit if the market goes down very sharply. And experienced investor, I think they should do nothing. And if anybody has been in the market for last 5 years, I think he would have gotten used to the ups and downs and the wild context of the market. Do nothing. And I don't think they need the advice, because last 5 years we have got many opportunity where a market would have scared somebody out of the market forever.
Even after you've been a long-term investor, it's not so easy to not panic in such a situation where you see such sharp declines in the market. So in such a case, what should one do?
One is that you have to really get used to that this is the nature of the market. There is nothing new about it. Market goes up sharply and dramatically, and market falls dramatically and sharply, and over a period of time it gets you superior return. Now what is that period of time? I think it is 5 to 7 years time frame. Can you profit from this? You can profit from this if you need your money in recent future, and you can take the money out. Then you can keep smiling when the market is going down. But it is very difficult to benefit from it in a guaranteed way, in a predictable way, that yes, you have taken your money out and after that the market goes in a tailspin and dies. Market is not going to die, businesses are not going to die. Some of them will prosper, some of them will thrive, some of them will become even bigger. One thing to keep in mind, one thing which will come in handy, that most investors commit few mistakes when the markets are at low, and your returns are optimized or maximized only by investing in the lean times of the market. So this is something, if you're a long-term investor, many of those investors should feel happy that you are buying cheap today. And but that is far easier said. You need to really experience it and work on an asset allocation and stick to it. That is, I think, the only insurance that investors have.
Time now to move on to our viewers' questions. The first one has been sent in by Sharan Singanamala. He asks, given the current volatility, where would you suggest investing a lump sum of 50 lakh rupees? He has a horizon of over 15 years. Also, would it be fine to spread it over 9 to 12 months?
The last part of the question is the most important, because he is not asking a question, he's asking a reaffirmation.
Yeah.
And yes, absolutely. And in fact, I would like to give a principle of how I would approach this spreading of your money. Depending, if this 15 lakh rupee has taken many years for you to accumulate or save, or it is a once in a lifetime bonanza that has come your way because you sold some family assets or realization from any such thing, spread it over the next 3 years, because you have a lot of time. You have 15 years, maybe more, and spreading it over the next 3 years time, 3 years on a monthly basis will make sure that you will not have regret. And markets can be in a tailspin for a long period of time. People of late, I have witnessed. In fact, India has been extremely contrarian, populated by contrarian investors. On all the market falls, domestic investors and individual investors have invested money, while foreign investors have pulled out money. Now, the scale of money coming by way of SIP has been rising despite the wild, swings of the market. So, yes, you should invest through this volatile period. This is a great opportunity, but I don't know, there might be great opportunity ahead. Conservative spread will be 3 years. If you want to be a little more aggressive, 12 months. More importantly, which is the vehicle you should be investing? Look at a relatively smaller sized Flexi Cap fund.
All right then. Tejeshwara HM asks, would you suggest investing in a balanced advantage fund in the current market scenario, and how will it help?
Investors should not choose the kind of fund they want to invest depending on the market complexion. They should invest depending on their state. If you are a new investor investing in the market for the first time, or if you are a relatively new investor, or most investors should start with a balanced advantage fund, because they are a steadier take. Any new investor cannot reconcile with the current market. It looks like a gambling then. It does not look like a market. So and very difficult to decode, but at the same time, how to profit from it? Do your SIP, approach it conservatively. New investors start with a balanced advantage. Old investors start with carry on or invest with your equity fund, and that's it.
Now, Dinesh wants to know, how should a 55-year-old salaried person select the best mutual fund?
It's not enough information from Dinesh, but for a 55-year-old person, if he's going to retire in 5 years' time and he's still investing, then he needs a different set of funds. If he has retired and he's seeking income, because in all our investments have two purposes. Either we are in the accumulation phase and we are investing, or we have accumulated something, because investing is all about converting a cash flow into a capital. And once you have built a capital, deriving a cash flow from that. So depends on which stage he is in.
Yeah.
But best funds are best funds. There are funds which are, but at the same time, the best mutual funds are, they may not remain the best fund. Good funds turn bad and bad funds turn good. So you need to keep an eye on anything which is market linked. My sense is that, if you're still a long-term investor, investing for 5 years and more, invest in equity. But invest in, if you're a relatively new investor, follow the same conservative route, with some allocation to fixed income.
Yeah. The next question has been sent in by Rochelle. She asks, what kind of investment would you suggest for someone in their 20s, probably starting out?
Yeah, if this is the money which you can invest and forget, then I think somebody in the 20s who is venturesome should invest, can well start even with a small cap fund. There is a point to it. There's a case, there's something which one should keep in mind. They prove to be the most rewarding asset category.
Over a very long time.
Over a very long time. But in the worst of times, they actually are on a free fall, and that is quite unnerving.
Yeah.
When we had 2008 and few phases thereafter, in brief period of time they very easily decline in value by 50%. And that is something, your 100 rupee becoming 50 is something which most investors are not used to. So be aware of that. And in your 20s, I think, but I'll give a more methodical approach to it. If you are earning and going to pay taxes, start with your estimation of your tax saving investment requirement. Invest that much money in a tax saving fund, and there are great tax saving funds available for Indian investors. Then comes the remaining money that you can save. You can well save, start with a Flexi cap fund. If you are wanting to assume great risk because you are in 20s and you still have 40 years to work, then you can well even be investing in small caps. That is what I meant.
Okay.
In the overall context, yes.
Now, Suman Pal wants to know, how is PPF as an investment to save tax? Is it the best, he wants to know?
My advice to PPF investors or depositors, so to say, is that if you have it, keep it. If you don't have it, don't do it. And I'll give you the reason for it. The reason is that, PPF is a 15-year SIP into fixed income yielding it's a fixed income yielding investment. So when you are investing for 15 years, the worst of tax saving fund will get you more, would have gotten you more return
Than
PPF. So that's point number one. But at the same time, if you already have PPF, the interest income from PPF is tax free. So you should think of PPF as your fixed income allocation. And it is the finest fixed income alternative if you have already accumulated it, because it's a very popular investment. Most people have a PPF account, even if they may not have a mutual fund or any such market linked investment, but they generally have. In fact, till very recently, the number of investors who had PPF account was more than total number of equity investors in the country. So this one investment avenue, and it is rock solid, it is backed by, it's the safest investment avenue, and it gets you interest income, which generates which is completely tax free. So if you have it, hold it. And if you don't have, invest in tax saving fund, it'll make you rich.
All right, now Periya Sami KS asks, how do guaranteed insurance plans work? Would you advise investing in them in place of other debt instruments?
Guaranteed insurance plans work. They guarantee you some return. And for a small part of your money is actually going towards insurance. At least the insurance laws, the regulations have mandated that at least 10% of the money, his premium payment or his payment, his contribution should be going towards insurance premium. Should be buying insurance with 10% of his money. So as a result of that, you don't get the finest of insurance, you don't get the finest of return, and the moment somebody promises you return, you get very low return. So anyway, interest rates have come down to very low levels. People are, old people, depending on interest income, are realizing the pinch, or are in great difficulty. And these guaranteed insurance investment plans are unlikely to be yielding anything meaningful. So I wonder that they will be able to beat inflation. And by beat inflation, many times we have this academic notion of inflation. The inflation rate of 4%, 5%, what we hear is one aspect, which is the economic reading. But my inflation is different compared to an old person's inflation, because if somebody is requiring, is in a poor health, retired, and he requires help or care, his inflation might be rising very rapidly. Likewise, so it depends on the complexion of your spending. You look at your inflation, how much you needed 3 years back for your day-to-day living, and how much you need today, and that difference is your inflation, and keep that in mind, and also the changing needs. So with that in mind, I think these guaranteed investment insurance plans could be extremely disappointing uh, in exchange for the guarantee.
So, all right, then should go for debt instruments rather than going for guaranteed.
Either debt instruments, or debt, if he is a long-term investor, which he is likely to be, because insurance plans might as well work on a very conservative plan, 10-15%, because without mixing little bit of equity, you are unlikely to run the potential, you are unlikely to have the chance of matching inflation, if not beating inflation.
Okay, Deepak Lal wants to know, is there any restriction on withdrawing money from liquid funds? How safe are they?
Going by the regulatory changes that have happened in the last 2 years, they are reasonably safe. I would say that they are almost safe. The risk of loss is virtually nil. Is there a restriction on withdrawing money from withdrawing money from liquid fund? Not at all. You can put any amount of money, and this is what was primarily used by companies for their surplus.
So putting in any amount and withdrawing
withdrawing it any amount, and over any time period. You can put your money today and take your money day after, and you will still get one day's return on your investment. So there is no restriction, and they are very safe.
All right, Renu asks, which is better among a flexi cap and a multi-cap fund?
Flexi caps are better because the fund manager has the flexibility of investing wherever he wants to, and use it opportunistically. But they also have a constraint. Flexi caps are facing a constraint because most of the flexi caps, as they get bigger, and the moment and by bigger I mean they cross the threshold of 10,000 crore in size, then investing in small caps become meaningless, because to have meaningful exposure to small caps, even 10-15% amounts to running a 2,000 crore small cap fund. So what I have witnessed is that whatever be the claim of a fund manager, that they don't, they find the opportunities not in small caps, but I think and the same fund manager found all the opportunity in small caps before they turn big. So I would say that smaller sized flexi caps are better, and if they are good, they will get bigger, and then they stop investing in small caps, which I think for any long-term investor is an important exposure to have.
Chanda Basu Malik wants to know if equity savings funds are better than arbitrage funds for a systematic withdrawal plan and taxation.
If this is a long-term money, this is sizable amount of money, and you will depend on this income, then maybe investing in the equity savings fund will be a better option, because you run the it will optimize return. Arbitrage funds will get you return just like any liquid fund, and so if you have a sizable amount of money and that has to be invested, and you are withdrawing periodically, then invest in a equity savings fund. If this money is to be invested in a fund, and many investors actually take that money out to stagger their investment and moving it into equity, then maybe invest in an arbitrage fund or a liquid fund.
All right, now today's last query has been sent in by Manish. He asks, is it fine to stick with just 1 to 2 ELSS for 10 to 20 years? What CAGR can one expect?
CAGR, we have history now. We have a history going back 30 years. And 30-year-old ELSS, tax saving fund, if you look at the 30 years return, if you invested and forgot about it, I think ideal thing will be picking the rolling return of many of these funds. It has ranged between all the funds with over 20-year history, their return is ranging between 15 to 20%. So 15 to 20%, the worst of the fund is twice as much of the PPF, public provident fund. So one has to understand that the compounding magic that will happen. Now the first part of his question, that should one stick to one, ideally if you pick a good fund, and it remains good all through the period, maybe stick to one or two funds. But you have to keep an eye. Any market linked investment, you can't invest and forget. There are good funds which turn bad, and there are bad funds which actually turn good. So you can't really be hopeful that in a long period of time you will have a good fund which you invested and then it turned bad and you do nothing about it and then it will become good. And it has happened. That also has happened. Bad funds, they have turned big, they turned better. So I would say that the same principle of reviewing your investment, and when they remain bad for a lingering period of time, get out of them and actually move your money. And there is a mechanism. Your money is free from lock-in after 3 years.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.